Huh.
All right, class, welcome. Today we are going to crack the code on a really important piece of our retirement savings system, the pension adjustment reversal, or as we call it, a PAR. Now, I know the name sounds a bit intimidating, but trust me, stick with me on this one. By the end of our session, you're going to understand exactly what it is, why it exists, and, this is the cool part, how it can actually give you back valuable RRSP contribution room that you probably thought was lost forever.
Okay, so here's our game plan for today. We're going to start with the why, the RRSP room problem that PARs are designed to fix. Then we'll get into what a PAR actually is and how it restores that room. After that, we'll dive into the nitty-gritty calculations, first for contribution plans, then for the more complex defined benefit plans. We'll touch on some special cases you need to watch out for, and we'll finish up with the practical side of things, reporting. Sound good? Let's get started.
All right, first things first. Before we can even talk about the solution, the PAR, we have to really dig in and understand the problem it's trying to solve. And that whole problem, well, it all starts with this interesting interaction between your company pension plan and your personal RRSP. So this question right here, this is the absolute heart of the matter. Why does being in a company pension plan actually shrink your personal RRSP contribution room? Well, it all comes down to one word: fairness. The entire tax-assisted retirement savings system in Canada is built on this idea of a level playing field. You can't let people with generous company pensions also have the full, massive RRSP room that someone without a pension gets. That would be a huge, unfair tax advantage. So the government needed a mechanism to balance things out, and that mechanism is called a pension adjustment.
And here it is, the pension adjustment, or PA. Think of it like this. Every single year you're in a company pension plan, your employer calculates the value of the pension benefit you earned that year. That value becomes your PA. And here's the kicker. That PA amount doesn't reduce your RRSP room for the current year, but for the following year. It's a direct reduction. And the whole point, as I said, is to prevent double dipping on tax deductions for retirement savings. It's the system's way of ensuring you only get one bite at the tax-sheltered apple each year, whether it's to a pension or an RRSP.
Okay, so that makes sense, right? A PA reduces your room to keep things fair. But what happens when the system gets it wrong? I mean, your PA is based on a benefit you're expected to receive in the future. What if you leave your job after a couple of years, before your pension is vested? You don't get that benefit, so now you've lost RRSP room for nothing. That's not fair either, is it? Well, that's exactly where the pension adjustment reversal comes into play. It's the fix. It's the solution. So, the pension adjustment reversal, or PAR, is basically the tax system's oops, my bad button. It's designed to add that contribution room back to your RRSP limit. The logic is simple. If you terminate your membership in a pension plan and the money you actually walk away with is less than the total PAs that were reported for you over the years, the system owes you that room back. It's a true reversal of that original adjustment, making you whole again from an RRSP perspective.
And you don't have to just take my word for it. The CRA's own guide puts it perfectly. They say that by restoring this room, PARs make the system fair and more effective. And think about that last part, for people who change jobs or move in and out of the workforce. This isn't some obscure rule for a rare situation. In today's economy, this is a core feature that reflects the reality that lifetime employment with one company, well, that's just not the norm anymore. It's a critical piece of the puzzle for a mobile workforce.
All right, theory time is over. Let's roll up our sleeves and get into the actual calculations. We're going to start with the easy stuff, the most straightforward cases. Deferred profit sharing plans, or DSPs, and money purchase plans, which you'll also hear called defined contribution, or DC plans. For these, the math is refreshingly simple.
You're going to love this. For these kinds of plans, the rule is as intuitive as it gets. The PAR is simply the total amount of employer contributions and any other forfeited amounts that you didn't get to keep when you left. So, if the vesting period is, say, 2 years, and you leave after 1, all that money the employer put in for you, you forfeit it. And that exact forfeited amount becomes your PAR. It's a perfect one-to-one reversal. Let's see it in action with an example. Okay, check out Paul's case here. In 2015, his employer put in $1,000. That created a PA of $1,000. In 2016, they put in another $500, creating a $500 PA. So his RRSP room was reduced based on that total of $1,500. But here's the thing, Paul leaves his job before he's vested, so he has to forfeit all of it. He walks away with nothing from the company. The result?
His PA is exactly, to the dollar, the $1,500 he forfeited. And here's a super important point to remember for the exam. Investment earnings are never part of this calculation. We only care about the amounts that originally made up the PA.
Okay, everybody, deep breath. We've handled the easy part. Now we're moving on to the main event, defined benefit plans or DB plans. With these, things get a little more interesting. See, unlike a DC plan, which is just a big pot of money, a DB plan promises you a specific income in retirement based on a formula. So it stands to reason that calculating the par for one of these also requires its own special formula. Pay close attention here, this is where a lot of people get tripped up.
And here it is. This is the formula you need to burn into your memory. PAR equals A plus B minus C minus D. Now, on the surface, it looks pretty harmless, right? Just 4 letters. But the devil, as they say, is in the details. The whole game here is knowing exactly what goes into A, B, C, and D. So let's unpack each of these variables one by one.
First up is amount A. This is your starting point. Think of it as the total damage to your RSP room. It's simply the sum of all the pension adjustments, all the PAs, that were reported for you during your entire time in that specific part of the pension plan. It represents the grand total of RSP room that was taken away because of your pension. This is the big number that we are potentially going to reverse.
Next, we have amount B. This one deals with something called a past service pension adjustment, or a PSPA. This happens when you, for example, buy back years of service you missed. Now, that PSPA also reduces your RSSP room. The key word here is grossed up. That just means we take the full value of the PSPA before any reductions. Why? Because sometimes you can pay for a PSPA by transferring money from your RRSP. We need to add the full PSPA value back in here to make sure the PAR calculation accurately reflects all the RSSP room that was used up for that past service benefit.
Okay, now we get to our first subtraction, amount C. This is probably the most intuitive part of the formula. Amount C is the money you actually got. It's the lump sum payout, the specified distribution you received when you terminated your plan membership. And it makes perfect sense that we subtract this, right? You can't get RRSP room restored for a benefit that you literally have in your hands. So what you got paid out, we take that away from the total.
And our final piece, amount D. This is another subtraction, and it's for a very specific scenario. Imagine you leave one job with a DB plan and move to another one that has a reciprocal agreement. You're able to transfer your pension credits directly from Plan 1 to Plan 2. In that case, you haven't actually lost anything, have you? The benefit wasn't paid out or forfeited, it was just replaced. It moved from one house to another. So amount D subtracts the value of that transfer. In many of these cases, this will wipe out the PAR entirely, bringing it to 0 because no benefit was truly lost, so no RSP room needs to be restored.
Okay, let's make this real with Julie's example. So, amount A, her total pension credits, comes to $40,000. Amount B, a PSPA she had, adds another $10,000, so A plus B is $50,000. That's the total RRSP room that was reduced over her time in the plan. Now, when she left, she got a lump sum payout. That's amount C of $35,000. Amount D is 0 because she didn't transfer anything. So we run the formula, $40,000 plus $10,000 minus $35,000 equals a PAR of $15,000. See how it works? The system calculates that she was shortchanged by $15,000 in benefits compared to the RSP room she lost, so it gives her that $15,000 in room right back.
Now here is a very important wrinkle you have to know about for amount C. The whole pay and PAR system, it didn't even exist before 1990. So what do you do if someone's payout covers service from, say, the 1980s? Well, you can't include that pre-1990 portion in the PAR calculation because no PAs were ever generated for that service. So you have to prorate it. Look at Nick's situation. He gets a big payout for 31 years of service. But we figure out that only 25.5 of those years were after 1989. So we do a simple calculation, we multiply his total payout by that fraction, 25.5 over 31. The result, $125,400, is his actual amount C for the formula. You have to carve out that pre-1990 service.
Okay, let's talk about one of the most common mistakes I see students make. The tax world loves its acronyms, and here we have 2 that are dangerously similar, PAR and PAC. Pension Adjustment Reversal versus Pension Adjustment Correction. They sound alike, but I promise you they are totally different animals, used in completely different situations. Let's get this straight right now so you don't mix them up.
So look, here's the bottom line. The key difference is the reason they happen. A PAR happens for one reason and one reason only. You terminated your membership in the plan. You left. A PAC, on the other hand, happens because of an error. A mistake was made. Maybe the employer overcontributed by accident, and that money had to be returned. So think of it this way. A pay-R is for a legitimate event, leaving a job. A PAC is to fix a screw-up. One restores room for a benefit you never got. The other restores room that was taken away by mistake. Totally different functions.
Okay, so we've covered the what, the why, and the how of the calculations. Now for the final piece of the puzzle, the practical application. I mean, it's great that you've calculated a PAR, but how does the CRA actually find out about it so they can give you your RRSP room back? Let's look at the reporting process.
The good news here is that for you, the individual, this part is pretty hands-off. The responsibility falls squarely on the plan administrator. They are the ones who have to report the pair on a 1010 return. They do this quarterly. Now, you will get a 1010 slip in the mail, but, and this is important, you don't file it with your tax return. It's just for your records. The CRA gets its copy directly from the administrator, and they will automatically update your RSSP contribution room. No work required on your end. And one last key takeaway, if the final pair number is $50 or more, it has to be reported. But if it's 0 or negative, no 1010 is issued. Nothing happens.
And that brings us to our closing thought for today. And it's a big one. This entire PAR system, as elegant as it is, was designed back in the 90s. It was built for a world where people had long-term jobs, and changing jobs a few times was the exception. It works really well for that world. But does it fully and fairly account for the reality of today? For the gig economy, for contract work, for people who might be in and out of multiple plans in a short period? Is our tax policy keeping pace with how we actually work now? That's a question I'll leave you with. It's something we, as future tax professionals, need to be thinking about. Okay, that's all for today. Thanks, everyone.